Hello, and welcome to another episode of Treasury Talks, where we speak with thought leaders across the U.S. On really pertinent matters as we deal with some of the challenges of COVID. When we look at the markets, some of the other things that are sort of going on in our environment. I am so honored to have with me today Dan Scholl. Dan, you have such a deep history, not only working with the state of Delaware in the early stages of your career, but sort of throughout the private sector. Can you give us a bit of a recap on how you came to be Dan Scholl?
Thanks, Colleen. Yeah, I appreciate it. About 30 years ago, I came down to interview with the state of Delaware in their budget office and ended up taking a job there as the healthcare policy analyst, and had worked my way up over 10 years to work for Governor Carper as his economic development advisor. And then I was asked to come on the asset management side and work with investors and endowments and foundations and governments like the state of Delaware to manage their investments. And I took a pit stop working for you as the deputy treasurer for 6 months early on in your administration, which I very much enjoyed. And I came back to run the Municipal bond group for Wilmington Trust here in Wilmington, Delaware, where I am today.
Well, and I have to say, not only was it a pleasure to have you for 6 months, it's been a wonderful friendship, and I think certainly you're an asset to Delaware and to M&T and Wilmington Trust. So thank you for that. I'd love to talk a little bit about what the markets are looking like right now. And some of the thoughts that I have are kind of centered around the impact on markets from the perspective of the Ukraine-Russian sort of dilemma that's unfolding right now.
We've seen world markets react very volatilely, obviously, in any kind of geopolitical crisis like this. So you have investors who are flooding into the U.S. Treasury market. That keeps yields down and prices up. It's obviously a safe haven. The United States is still the safest credit on the face of the earth. So when investors have cash and they're looking to earn some money, they'll typically move to the U.S. Treasury market. Obviously, equity indexes across the world are down. The Dow's down almost 10% year to date. The S&P's down roughly 13% year to date. So that's to be expected in a crisis like that. Remember, we came in to this year with inflationary concerns. Inflation is somewhere around 7.5%, which is high, very high relative to where it's been historically. Remember, over the last several years, as we're coming out of the pandemic, inflation was very, very low at 1%. And we also had a Federal Reserve that was looking to hike interest rates because interest rates have been artificially low for a very long time. If you remembered, they were lowered in the pandemic in order to, make borrowing easier and businesses be able to reinvest in their business to keep them afloat. Now we're at a point where the economy has gotten much better, and it's probably time to raise interest rates. And all of those, economic signals that we were trying to address have changed dramatically. So oil is now at $127 a barrel. Over the last several days, it's raised. Ukraine and Russia are the largest producers of wheat in the world. They produce about 40% of the world's wheat. So wheat prices have gone up. Nickel and palladium has gone up. Those are very important products in energy and electronics, and also fertilizer. I mean, Russia is also a big producer of fertilizer. So to other parts of the world. So if you look at Brazil, their food prices are rising dramatically because of fertilizer prices. So, the average person here in the United States sees it at the pump, but they will also see it in terms of food prices. Food prices were already rising because of inflation. And I think it's going to be a continued upward expansion. So it's a very interesting time, both in the United States and around the world for how markets are going to react and continue to react to the Ukrainian crisis now.
Yeah, it's, you and I tend to sort of hone in on that sort of treasury and municipal market But it's kind of interesting, the thought process sort of behind what's happening with our commodities and the commodities market, because it really has this domino effect when we think about the fighting and the invasion of the Ukraine. What about, can you just give a generalized sort of, I don't want to say kindergarten level, but maybe first grade level? What's the difference between the Treasury market and the municipal market?
The difference between the Treasury market and the municipal market is that the Treasury market is a global market. Obviously, the U.S. government is issuing bonds for different reasons. Over the past several years, we've issued a lot of debt in order to finance our deficit. And investors from around the world are looking for a positive return in one of the safest asset classes. There's a lot of demand for the U.S. Treasury market by investors from across the world. I would say roughly 25% of the U.S. Treasury market is owned by Asian investors. So that would include Japan, China, and other countries in Asia. And the municipal market is very idiosyncratic. It is very much of a U.S. dominated market. Investors are typically in the municipal market to provide tax exempt income. So the income is exempt from federal taxes and can be exempt from your state, depending on how your state laws work. But it is also a much, much smaller and what we call less liquid bond market, which means that if you were looking to sell a bond in today's market, you'd probably have less people interested in buying it than you would in a U.S. Treasury. There are also the vast nature of how many issuers. There's over 50,000 issuers in the U.S. That are issuing municipal bonds. And so they come in all shapes and sizes. So the University of Delaware and Delaware State University are two large issuers. Christiana Hospital is a very large issue. And of course, you're responsible for the state of Delaware, which is the largest issuer here in the state of Delaware.
So, and just as a general rule, whether it's Treasury or municipals, generally the risk is a touch lower, and the return tends to be sort of more of a longer term trajectory overall.
Yeah, that's correct. In both markets, in both the Treasury market and in the municipal market. I mean, if you compared the municipal market to the corporate market, it's an $11 trillion corporate market, $4 trillion muni market. So we're about a third of the corporate market. And if you think about all the investors in the corporate market, they're all over the world. And so while we do have overseas investors buying state of Delaware GO bonds, it's much less than you would see in the corporate market. So today, if I wanted to buy a Walmart in the corporate market, it's easily accessible. If I wanted to buy the state of Delaware today, I looked before I got on this call, there was probably about 5 issues that were available. And there were, 5 different maturities, 5 different issuers. So if I really wanted to buy the state of Delaware GO, I'd probably have to wait a couple more days till someone would want to sell me their bonds. So that's what when we say liquidity, that's what we mean by liquidity. It's easier to get a corporate or a Treasury than it is to buy a specific municipal. So if you're looking for relatively safe credit, there's probably no better bond in the marketplace than a state of Delaware bond. The one thing that sticks out to me when I look and talk to other state chief financial officers and treasurers around the country is that here in Delaware, when we have difficult times, it doesn't matter what party you're from, we tend to get together. So, I've been through various recessionary periods when revenues have gone down. I've also been on the flip side when revenues have gone up. And one thing that is very apparent that is not the case in other states is that we can all get in a room together, as whether it's in the legislature or Buena Vista, there's been many, or in the governor's office or in, leadership's office, and hammer out the details of what the state needs to do in order to resolve its budget crisis or fiscal crisis. And that, if you read through the rating agency reports and you talk to investors around the country, that's what stands out in terms of Delaware. That's not the case in New Jersey. That's not the case in Illinois. Many states don't have that tradition of working together. And I think, being a small state helps us in some respects. And the other reason I would say, Colleen, is that we have a deep history, both of legal and in our Constitution, in terms of setting up, important metrics that we follow. And I know you've been very involved in the other post-employment benefits, OpEB as we call it, in terms of making the state address that important issue as we move forward, because long-term liabilities don't ever go away; they only go up. And so, at some point, the state and other states and other municipal governments need to address that. And I would say even that particular issue, the fact that the state actually passed legislation and appropriated a portion of the revenues in order to put it in a fund, is the first step in addressing the issue.
Yeah, and just to kind of provide a little bit of back, you mentioned that legislation that was passed. OpEB refers to other than pension employee benefits, and a lot of states and other municipalities have unfortunately negated to fund their pensions. Delaware has not done that. We fully fund our pension arc every year, so that's a good point. Right. But the one thing that stands out on our balance sheet, and has for some time, is that other than pension employee benefits, which essentially is our healthcare benefits that we offer our retired employees. And and so when we think about the financial impacts and some of the obstacles, that being on our books as a really large unfunded liability can potentially affect our AAA bond rating. As we start to tackle funding OpEB, what do you think is kind of like the next challenge for Delaware, or where do you see us sort of being at risk from your perspective?
I think going forward, obviously healthcare costs rise faster than inflation. At least they have in the past, with 7.5% inflation. I don't know how much higher they need to be, but I think on the flip side might be the expenditure side of the equation. So what can the state do in order to manage its costs better? That could be some things I know you've been working on, with health insurance premiums and drug pricing. That could be cutting back benefits. I mean, again, the state has always been very generous with its benefits, and we obviously pay less in salary, so that's one of the trade-offs. But yet, we have to. You have a finite amount of resources, so you need to figure out the best way to deliver that. So I think, in my mind, those are some of the things that I know you've been involved with, and that the state has looked at in the past. I just think we're in a good revenue time, so maybe perhaps some of those things we should look at even harder now.
Yeah, that's a great point. I think you're absolutely right. Well, Dan, this has been such a joy to reconnect and sort of talk about some of the behind the scenes conversations that we tend to have, just about Delaware fiscal processes. And I really appreciate you connecting with me today. Thank you so much.
Okay. Thank you, Colleen.